Hello, neighbors, and welcome back to the neighborhood. I am Squealer D, and I am back again. And this time, friends, we are here in the morning on money. That's right. We are in Investopedia learning today about mutual funds in our series of stock market learning. And I, my friends, am on my way to becoming a a stock market master. That's right. I am going to master the stock market, and I am doing it all online so that you can do it with me. Yes, my friends, learning the stock market online every single day for free so that you can log in right here with me in the morning live stream. Or guys, guess what? I am leaving the videos up so you can watch them later. You can watch them a million times, and we can learn the market, okay? So that is the goal. If you are here, well done, my friends. You are in a good place in your life. If you are willing to expand your mind and learn, you are doing good. Let me tell you what. So like I said, this is an entire series. You are currently watching, I think, episode, what are we on, guys? We're on episode 34. Yes, we don't do this every day, guys. Just Monday through Friday for anywhere from a half an hour to an hour and a half a day, just whatever the lesson needs. It's a different lesson every single day. Sometimes we go over things more than once so that we can bury them in our minds. And when bury them, I mean keep them forever, guys. We are learning. This is not a pump and dump type of situation for learning. We are not going to pump the information into our brain and then dump it later. We are learning forever. We are learning so that we can be money people like this guy right here, and this guy right here. Look at him. Look at him. He looks like he's got money knowledge. So that's where we're headed, guys. If you are here for the ride, I congratulate you and I thank you. I didn't want to do this all alone. That's why I'm here with you guys. It is better and more beneficial to make money with a team, guys. If you have a team, you will do better. That's just is what it is. Find yourself a team very, very early on. And I don't mean a team that can give you money. I mean a team that can help you with money. Ideas, guys. Perhaps, who knows what. Maybe you guys could be an actual money team and work together so that somebody could work and somebody else can work and you're both putting money into the same fund. Get it going faster that way, guys. If you have a teammate, you get to go faster. That's just is what it is, okay? So, welcome, my friends. We're going to do this. It is an article, of course, by Investopedia. We use them a lot because so much of their information is free. And there's tons, guys. If you want to bop over to this one, this is their, look, an Investopedia encyclopedia. And it has all of the terms, dude. All of them. And you can jump through, like, we're going to learn about mutual funds today. So you could bop down here and they have mutual fund. You can bop to bonds and you can learn about a bond. And each one has articles, you see, and it explains what each one is. You see how great that is? It's wonderful. So if you read something, let's say you're reading through and you hear something about bull market, guys. Look, what is a bull market and how can investors benefit from one? You see how great that is? This right here, guys, I favorited it. You can see I have a little star right behind my picture. I have a star. Go up here by my picture and star it. And that, guys, will let you keep it in your favorites. And you will have a financial term dictionary. Yay, Investopedia. So today's is mutual funds, different types and how they are priced. And this is by Adam Hayes, who is a writer with 15 years of Wall Street experience as a derivatives trader. I would like to pick Adam Hayes' brain, and this is the closest we could get, guys. So before we get started, I do have my coffee. D for dinero, because you know that's what we're about. We're going to get the money, guys. Today's coffee is not gross, guys. I woke up thinking I'm not going to have any coffee. All I've been having lately is thumbs down coffee. But today I made some Dunkin' Donuts hazelnut coffee, guys. It's really good because I put sugar-free vanilla creamer in it. And let me tell you what, vanilla and hazelnut is a little hazelnut punch to my lips. It's so good. Gotta give it a go, guys. Hazelnut throws a little difference in there, Okay, so mutual funds, guys. Let's get into them. And then, like I said, after mutual funds, we are going to bop into this, which I also have favorited, guys. It's Yahoo Finance, and this is the homepage. And we're going to go through some of the news so we can get in the habit of always checking finance news, guys. We got to be up on the news, okay? So what is a mutual fund? A mutual fund is a financial vehicle that pools assets from shareholders to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. What is a prospectus, guys? It's a formal document required by and filed with the Securities and Exchange Commission that provides details about an investment offering to the public. A prospectus. That's a good word, guys. Let's read the prospectus. I like that word. So, mutual funds give small or individual investors access to professionally managed portfolios of equities, bonds, and other securities. Each shareholder, therefore, participates proportionally in the gains or losses of the fund. Mutual funds invest in a vast number of securities, and performance is usually tracked as the change in total market cap of the fund, derived by the aggregating performance of the underlying instruments. Most mutual funds are part of larger investment companies, such as Fidelity Investments, Vanguard, T. Rowe Price, and Oppenheimer. A mutual fund has a fund manager, sometimes called its investment advisor, who is legally obligated to work in the best interest of mutual fund shareholders. So, they're legally obligated, guys, and this is why they are questioning the bank CEO, like Greg Becker, who is the bank CEO of, or was the bank CEO of SVB before he let that thing go straight to the toilet. And if you are a CEO of a large money investment advisor, a fund manager, a bank CEO, you are and you rightfully should be legally obligated to work in the best interest of mutual fund shareholders, not just yourself. And that guy Becker, you guys, read about Becker. Greg Becker, he took a $10 million salary the year that his bank closed. It closed, guys, in April. That's only 3 or 4 months into the year, but he got paid $10 million. He's not giving back that $10 million. He also got a bonus for $1.5 million for a bank that closed, guys, when it's legally obligated to work in the best interest of the bank. He did CEO sell right in the beginning of the year in January. He knew that bank was failing in January, and he still sold off all of his shares for millions of dollars. You guys we hear people complain about welfare, but we have these people taking that money out of the bank. It was worse than welfare, guys. It was like giving him $15 million for free. So if you ever have complained about somebody getting $500 in food stamps, yet you don't complain about a man taking $15 million from a job that he was legally obligated to work in the best interest of the shareholders, and he did not, or the shareholders, the bank holders, whatever you want to call the bank people, he was working in the best interest of the people that banked at that bank, and he did not do that, guys. And we don't hold them accountable. That man will go back and get a different job as a CEO. He'll work somewhere else, and he will make more millions. We should take that money. He didn't work for a full year and he didn't do his job even if he did work. That money, that 15 million should go towards the billions that taxpayers are paying. That's coming out of our money, guys. We are paying for the SVB failure. They say that they're blaming it or not blaming it. They say that they are making like Chase Manhattan, JP Morgan Chase, that they're making them pay for it. They're making big banks pay for it. But who do you think that the big banks are going to pass that ticket down to? Us, guys. They're going to raise our fees. They're going to take more of our money when we bank with them to pay for this, to pay for Greg Becker to get $15 million to do absolutely zero. So that is why we have to know the news, okay? Because if we didn't know Greg Becker's name, he would get away with stealing $15 million and nobody would ever hold him accountable. We have to at least hold him accountable mentally, guys. If we don't know about it, then he never did it. So every chance you get, you tell everybody that mentions food stamps or free money, you mention old Greg Becker, who got $15 million for free this year, and we will pay for it. Us, the people, we will pay his $15 million and the $700 billion that the bank was short. We'll pay all of that. So that is why we have to learn this, guys, because people that know the money, they will always take the money from us, from the people who don't know the money. I know it sucks, but if you become one of the people that take the money, you're going to be taking it from somebody else. That's the way capitalism works. If you go in here and you invest in a fund the same way that Greg Becker did, you're going to be taking advantage of the poor people. That's what the money market is. It is people on top taking advantage of people on the bottom. That's capitalism. That's the money market. That's investing, and that is finance, okay? And that is why you have to turn off your emotions when it comes to money. Because unless you have the powers to turn off capitalism and save our country, there's nothing you can do but play the game. And play the game in the best way possible. And that means not like Greg Becker. We want to follow these rules. You guys, they have put many rules in place for us to act on the stock market and make money, to use mutual funds and make money. But they also put in caveats so that they don't lose all of their money. So you learn their system and you become one of them. That's it. That's the options, guys. Okay. So we are learning this to become one of them. But at the same time, we understand that the system is already rigged. It's already, there is an up and there is a down. There is a rich neighborhood and there is a poor neighborhood on the market, okay? So keep that in mind, because we're always going to see these big guys who do things that maybe aren't the best for the people that they are supposed to be keeping the best interest for. You keep that in your mind and you will not get ripped off or taken advantage of as much. So the key takeaways of this article is a mutual fund is a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities. Mutual funds give small or individual investors access to diversified, professionally managed portfolios. Mutual funds are divided into several kinds of categories, representing the kinds of securities they invest in, their investment objectives, and the type of returns they seek. Mutual funds charge annual fees, expense ratios, or commissions, which may affect their overall returns. Employer-sponsored retirement plans commonly invest in mutual funds. So, how are mutual funds priced? The value of the mutual fund depends on the performance of the securities in which it invests. When buying a unit or share of a mutual fund, an investor is buying the performance of its portfolio, or more precisely, a part of the portfolio's value. Investing of a share of a mutual fund is different from investing of shares of stock. Unlike stock, mutual fund shares do not give their holders any voting rights. A share of a mutual fund represents investments in many different stocks or other securities. So it's like they took a folder and they put a bunch of businesses inside of the folder. And then what you do is you invest in the entire folder. Not just one, but an entire folder of things. That makes sense. Because if you can expand your portfolio, if you only have a little bit of money to play with, that gives you more chance of having a positive investment. So, the next step to invest. The price of a mutual fund share is referred to as the net asset value, the NAV, per share, sometimes expressed as NAVPS. A fund's NAV is derived by dividing the total value of the securities in the portfolio by the total amount of shares outstanding. Outstanding shares are those held by all shareholders, institutional investors, and company officers or insiders. Mutual fund shares can typically be purchased or redeemed at the fund's current NAV, which doesn't fluctuate during market hours, but is settled at the end of each trading day. The price of a mutual fund is also updated when the NAV PS is settled. The average mutual fund holds different securities, which means mutual fund shareholders gain diversification. Consider an investor who buys only Google stock and relies on the success of the company's earnings. Because all of their dollars are tied to one company, gains and losses are dependent on the company's success. However, a mutual fund may hold Google in its portfolio, where the gains and losses of just one stock are offset by gains and losses of other companies within the fund. So how are returns calculated for mutual funds? When an investor buys Apple stock, they're buying partial ownership or a share of that company. Similarly, a mutual fund investor is buying partial ownership of the mutual fund and its assets. Investors typically earn a return from a mutual fund in 3 ways, usually on a quarterly or annual basis. Income is earned from dividends on stocks and interest on bonds held in the fund's portfolio, and pays out nearly all of the income it receives over the year to fund owners in the form of distribution. Funds often give investors a choice either to receive a check for distributions or to reinvest the earnings to purchase additional shares for the mutual fund. And you guys see that? If they send you a check at the end of the year in the form of a distribution, and you have the choice to receive a check for that you could put into your account or reinvest into additional shares of the mutual fund, you are growing your money, guys. By investing in this portfolio, when you get your dividend or your distribution, you have just grown your nut. You see that? You did have some, and now you had some funds. They gave you a distribution, and now you have additional shares of that fund. So next time, your distribution will be bigger. That is called growth, guys. If the fund sells securities that have increased in price, the fund realizes a capital gain, which most funds also pass on to investors in a distribution. When the fund shares increase in price, you can sell your mutual fund shares for a profit in the market. When researching the returns of a mutual fund, an investor will see total return, or the change in value, either up or down, of an investment over a specific period. This includes any interest, dividends, or capital gains the fund generated, as well as the change in its market value over some time. In most cases, total returns are calculated for 1, 5, or 10-year periods, as well as since the day the fund opened, or the inception date. The different types of mutual funds. There are several types of mutual funds available for investment, though most mutual funds fall into one of the 4 categories, which include stock funds, money market funds, bond funds, and target date funds. Stock funds. As the name implies, this fund invests principally in equity or stocks. Within this group are various subcategories. Some equity funds are named for the size of the companies they invest in, small, mid, or large cap. Others are named by their investment approach, aggressive growth, income-oriented, value, and others. Equity funds are also categorized by whether they invest in domestic, like U.S. stocks, or foreign equities. To understand the universe of equity funds is to use a style box, an example of which is below. Funds can be classified based on both the size of the companies, their market caps, and the growth prospects of the invested stocks. The term value fund refers to a style of investing that looks for high quality, low growth companies that are out of favor with the market. These companies are characterized by low price to earnings, their PE ratios, low price to book, PB ratios, and high dividend yields. Conversely, growth funds look to companies that have had strong growth in earnings, sales, and cash flows. These companies typically have high PE ratios and do not pay dividends. A compromise between strict value and growth investment is a blend which simply refers to companies that are neither value nor growth stocks and are classified as being somewhere in the middle. So, equity style box. We have large and growth, medium and value, or medium and blend, or medium and growth, and all of these. So, these are the different types of equity. You could have a large value, a large blend, a large growth. Got it. Large cap companies have high market capitalizations with values over $10 billion. Market cap is derived by multiplying the share price by the number of shares outstanding. Large cap stocks are typically blue chip firms that are often recognizable by name. Small cap stocks refer to those stocks with the market cap ranging from $250 billion to $2 billion. These smaller companies tend to be newer, riskier investments. Mid-cap stocks fill in the gap between small and large cap. A mutual fund may blend its strategy between investment style and company size. For example, a large cap value fund would look to large cap companies that are in strong financial shape, but have recently seen their share prices fall, and would be placed in the upper left quadrant of the style box. The opposite of this would be a fund that invests in a startup technology company with excellent growth prospects, small cap growth. Such a mutual fund would reside in the bottom right quadrant, small and growth. So if it has a lot of growth, it's going to be in growth, but depending on its size, will it be in medium, large, or small? You see how it works? So if you're going to get a blended company, is it small, medium, or large? If you're going to get a value company, is it small, medium, or large? And then you just fill in the box. So it's getting cold, guys. It's not as good cold. So bond funds. A mutual fund that generates a minimum return is part of the fixed income category. A fixed income mutual fund focuses on investments that pay a set rate of return, such as government bonds, corporate bonds, or other debt instruments. The fund portfolio generates interest income, which is passed on to the shareholders. Sometimes referred to as bond funds, these funds are often actively managed and seek to buy relatively undervalued bonds in order to sell them at a profit. These mutual funds are likely to pay higher returns, and bond funds aren't without risk. For example, a fund specializing in high-yield junk bonds is much riskier than a fund that invests in government securities. Because there are many different types of bonds, bond funds can vary dramatically depending on where they invest, and all bond funds are subject to interest rate risk. Guys, an interest rate risk is what we are seeing when the feds jack up that rate. A bond falls prey to that. That's what happened to some of these banks. They had invested in these bond funds, right? And they had set it at a lower rate, guys, because the feds were at we were at the lowest rate that we had been in a long time. So these banks, they do tech startups, and they give out a bunch of money to tech startups, right? So they invested in these bonds. And you remember, bonds have a time. They just said they have a time limit. It could be 10 years, 5 years, whatever, right? So they were a bank, and they invested in a bunch of bonds at an interest rate that was provided by the Fed. And then the Fed raised those interest rates because of inflation, and the banks weren't prepared for whatever reason. For whatever reason, they weren't paying attention. They didn't care. It was planned. Somebody wanted those banks to fail. Or, which I don't believe, the CEOs were inept. And I don't believe that, guys. I don't believe that you become a CEO of a bank and you don't know what you're talking about with bonds. Well, they let the interest rates soar on these bonds that they had already purchased previously, guys. The interest rates soared, so when they cashed out, and they had to cash out, they couldn't hold the bonds and wait for the rates to go back down because they needed the money. People started taking a bunch of money out of their bank, right? When banks start getting wonkety and bonkety, people get scared. So they got scared. They heard banks were, you start to hear something and you're like, oh, no. Let me go get my money out of the bank. So they did. They made a run on the bank and they took their money out. But when they took their money out, the bank had no choice but to cash these bonds so that they could give people their money, right? Well, when they cashed their bonds at a higher interest rate, they ended up losing millions, guys, like hundreds of millions of dollars. And that loss was people's money. They had invested the people's money in it. So they had no money to give to these people. You know, millionaires, businesses with millions and millions of dollars had their money in there and they couldn't give it to them. So we had to have the FC, we had to have regulators come in, you guys, and stop this. They had to stop all of it. And they made a promise that the people will get their money. And guys, that is not always happening. If you have more than what they insure, and they only insure up to $250,000. So if you had $5 million in there and they only insure up to $250,000, you could have lost all your money in that bank failure. It's a risk. All financial gains and management is a risk, guys. Risk management is a name for a reason, because anytime you put your money into anything, there is risk. There's risk that the bank will fail. So people went to go get their money out. They had to cash in these bonds and they lost millions and billions of dollars. And now we are paying for it. Just like we paid in 2007 when the banks failed, 2008 with the bank failures. We paid for that. We ended up, they say the banks pay for it, guys. And I know you'll see that on news, like JP Morgan's going to pay 700, part of the 95% of the $700 million that is owed. But we're going to pay for that. JP Morgan's not coming out of his pockets like a good dad to pay for our items. JP Morgan is going to pass those fees on to us. You're going to pay more for your Chase banking account. Okay? They're going to charge you more for loans. They're going to get that money out of us. We will pay for that. So thank you, Greg Becker, for making sure you got your $20 million and leaving the rest of us high and dry, because we knew you bought these bonds, right? The bank bought those bonds. So did he do that purposely, or is he inadequate in his brain? Let's know. Let's ask him. They asked him all these questions. What they should have did was throw him in jail. When you take $15 million from a failing company and people have to pay for that, like we're going to have to pay for that, you should go to jail. You should go to jail. You should go to jail until every dollar is repaid. That's my opinion. Throw them in jail and these rich people stop ripping us off. There's never a threat of jail for rich people, guys. They literally don't go to jail. That dude, Jeffrey Epstein went to jail in a bank, in a library. Google it. When he did his time, he got out, guys. He was in there when it wasn't a jail. It was a library. They redid a library for him to stay in during his jail sentence. Yeah, Google it. Jeffrey Epstein's first jail sentence. Where was he? Rich people do not do the same crimes as us. They do special crimes, guys, because they get special treatment after they do their crimes. Like this guy, Greg Becker, all they did was question him. Senate questioned him. The House questioned him. Whoever questioned him, Congress. Who cares? Throw him in jail. You take $15 million and you let a bank fail, you go to jail. And then that means people that take those jobs, they will be worth the $15 million. Why let somebody in there that's going to let the bank fail? If you have a risk of jail, I bet you're not going to let that bank fail for $15 million. Because if somebody gave me $15 million, I would have made sure that bank didn't fall. Even if I had to go before it was going to fall and beg people for help. Like, why weren't these banks on the news begging for help 7 months ago? They saw it coming. They saw it coming years ago. They didn't though, guys, because we don't know enough. If we knew more, if we understood that they knew that this was going to happen, there's no way that they couldn't have known that this was going to happen, guys. He pulled out all of his money in January. So in January, when he was doing his sales, his stock sales, why wasn't he alerting us? Because we don't know enough, guys. They don't alert us because we don't know anything about it. And why tell us? Why tell us that they're losing and stealing money? They're not gonna. Let's finish this coffee up because it's pretty cold. mouse off. Okay. So we got to get smarter, guys, so that they cannot do that to us. So index funds. Index funds invest in stocks that correspond with a major market index, such as the S&P 500, which is the 500 largest companies in America, guys, or the Dow Jones Industrial Average. This strategy requires less research from analysts and advisors, so there are fewer expenses passed on to shareholders, and these funds are often designed with cost-sensitive investors in mind. Balance funds. Balance funds invest in a hybrid of asset classes, whether stocks, bonds, money market instruments, or alternative investments. The object of this fund, known as an asset allocation fund, is to reduce the risk of exposure across asset classes. Some funds are defined with a specific allocation strategy that is fixed, so the investor can have a predictable exposure to various asset classes. Other funds follow a strategy for dynamic allocation percentages to meet various investor objectives. This may include responding to market conditions, business cycle changes, or the changing phases of the investor's own life. And that makes sense, guys, because remember we learned yesterday that they even have types of vehicles for people that are in the end stages of their lives that may need to get their money out quicker, for a medical reason. Like they have, when you're older, you have way more medical problems. It just is what it is. So they might have a medical issue that they need money, so they need it to be more liquid. Or they may need to end it early, near the end of their life. So there are lots of vehicles, guys. Money market funds. The money market consists of safe, risk-free, short-term debt instruments, mostly government treasury bills. An investor will not earn substantial returns, but the principal is guaranteed. A typical return is a little more than the amount earned in a regular checking or savings account, and a little less than the average certificate of deposit. Income funds. And come back tomorrow, guys. We're going to learn all about certificate deposits and treasury bills, okay? When you see this, they have, what is a certificate of deposit? You can favorite, bam. Keep it in your favorites, and now we have it for tomorrow. So an investor will not, okay. So where do we go? Okay. Income funds. Income funds are named for their purpose, to provide current income on a steady basis. These funds invest primarily in government and high-quality corporate debt, holding these bonds until maturity to provide interest streams. While fund holdings may appreciate, the primary objective of these funds is to provide steady cash flow to investors. As such, the audience for these funds consists of conservative investors and retirees. International or global funds. An international fund or foreign fund invests only in assets located outside an investor's home country. Global funds, however, can invest anywhere around the world. Their volatility often depends on the unique country's economy and political risks. However, these funds can be part of a well-balanced portfolio by increasing diversification, since the returns in foreign countries may be uncorrelated with returns at home. Sector funds are targeted strategy funds aimed at specific sectors of the economy, such as financial, technology, or healthcare. Sector funds can be extremely volatile, since the stocks in a given sector tend to be highly correlated with each other. For instance, guys, if you had sector funds that were in hospitality or, hotels, whatever, I guess that's hospitality or travel, then you probably had a lot of volatility issues during the pandemic, right? Regional funds make it easier to focus on a specific geographic area of the world. This can mean focusing on a broader region or an individual country. Socially responsible funds or ethical funds invest only in companies that meet the criteria for certain guidelines or beliefs. For example, some socially responsible funds do not invest in sin industries, such as tobacco, alcoholic beverages, weapons, or nuclear power. Other funds invest primarily in green technology, such as solar, wind, and the power of recycling. And guys, I'm just going to touch on this for 1 second, because this is a moral issue. Let me tell you guys something. I am not saying don't invest in socially responsible funds or ethical funds that invest in companies that meet the criteria for certain guidelines or beliefs. I am not saying do not invest in this. What I am telling you is do not only invest in these. If you are religious and you are only going to pick your stocks based on your religion, do not trade stocks. You stay in fake money, paper money. Do not. If you think that you cannot buy any industry that relates to tobacco, alcohol, or certain beverages that have sugar or weapons, let me tell you guys, do not invest in the stock market. Save your money. Get a second job to save money. You cannot be ethical when it comes to money. I know that sounds horrible, but you name one person who is rich who thinks ethically at all times about their money. There's nobody, guys. Nobody is rich and it thinks ethically in regards to their money. Nobody. It's why poor people are poor, because some of them are more ethical than others, or they're more socially responsible, or they have different guidelines or beliefs that don't let them. But let me tell you what, when it comes to money, these people are not focusing on what is socially responsible or what is ethically responsible or morally responsible. If that is what you are worried about, the stock market is the wrong place for you. Capitalism is not a friend of any of these things: social, ethical, financial responsibility. It's not. It is a place for people to make money off of their money, and they do not care how it happens. They don't, guys. You have to believe me. You have to stop thinking that your feelings will coincide with money, okay? You have to get over that. So, just my 2 bits for the day on your feelings. Do not invest just because you like something, okay? That will lose your money, and you will be a little broke person sitting right back at the beginning. If you learn anything, learn that you have to separate your feelings, how you feel about things, from your money, okay? Separate it right now. Tell yourself, my money does not depend on my feelings, any of it. I can lose it and I won't cry. I can gain it and I won't cry. Money does not affect my emotions. And I know that like, oh, Squealer D, that's so easy to say. It's not easy to say, and it's not easy to do. And that is why we're taking this so slowly. That is why we are gaining the knowledge, guys. Because the more knowledge you put up in here, the littler and littler your fear is going to get of going outside of your guidelines and your beliefs and your criteria for your ethicalness and your social responsibleness. You have to get over that. And if you can't, if you're like, no, I'll never give up my ethics. Well, then let me tell you, stay off the stock market. Just like you wouldn't go, if you ethically don't want to do bad things, I wouldn't see you at the horse races, correct? You would never go to the greyhound races because you're ethically correct, right? You don't gamble. Let me also tell you, do not get on the stock market. It's not gambling, but you do not have, I don't know, the gut. I don't want to say the guts, guys. You don't have the emotions for it. And you can train your emotions. So right now, you put yourself in training that you will become emotionless about money. You train yourself right now. So exchange-traded funds, we know these are EFTs. A twist on the mutual fund is the exchange-traded fund, the ETF. I always call it EFT, ETF. They are not considered mutual funds, but employ strategies consistent with mutual funds. They are structured as investment trusts that are traded on stock exchanges and have the added benefits of the features of stocks. ETFs can be bought and sold throughout the trading day. So you guys remember mutual funds, they don't have like a chart that goes up and down during the day. They figure it all out at the end of the day. ETF has a chart like a mutual or like a stock that goes up and down during the day. So that's the difference. ETFs can also be sold short or purchased on margin. So you can use a margin account, guys, which is borrowed money, to buy an ETF. ETFs are typically carry lower fees than the equivalent mutual fund. Many ETFs also benefit from active options markets, where investors can hedge or leverage their positions. And options, guys, options are also this week. Yeah, that's right. Or actually, if we can't get to them tomorrow, which is Friday, we will get to them on Monday. So, where investors can hedge or leverage their positions. ETFs also enjoy tax advantages from mutual funds. Compared to mutual funds, ETFs tend to be more cost effective and more liquid. Mutual fund fees. A mutual fund has annual operating fees or shareholder fees. Annual fund operating fees are an annual percentage of the funds under management, usually ranging from 1 to 3%, known as the expense ratio. A fund's expense ratio is the summation of the advisory or management fee and its administrative costs. Shareholder fees are sales charges, commissions, and redemption fees that are paid directly by investors when purchasing or selling the funds. Sales charges or commissions are known as the load of a mutual fund. When a mutual fund has a front-end load, fees are assessed when shares are purchased. For a back-end load, mutual fund fees are assessed when the investor sells their shares. Sometimes, however, an investment company offers a no-load mutual fund, which doesn't carry any commission or sales charge. These funds are distributed directly by an investment company, rather than through a secondary party. Some funds also charge fees and penalties for early withdrawals or selling the holding before a specific time has elapsed. So a mutual fund, guys, is something you tie your money up in for a certain amount of time, whereas a stock you can go in and buy and sell. There's no, they may charge a fee for the transaction, but there is no penalty for early withdrawal like on a mutual fund. Currently, most individual investors purchase mutual funds with A shares through a broker. This purchase includes a front-end load of up to 5% or more, plus management fees and ongoing fees for distributions, also known as 12b1 fees. Financial advisors selling these products may encourage clients to buy higher load offerings to generate commissions. With front-end funds, the investor pays these expenses as they buy into the fund. To remedy these problems and meet fiduciary rule standards, investment companies have started designating new share classes, including level load C shares, which generally don't have a front-end load, but carry a 12b1 annual distribution fee of up to 1%. Funds that charge management and other fees when an investor sells their holdings are classified as Class B shares. So, the pros of mutual fund investing. There are a variety of reasons that mutual funds have been the retail investor's vehicle of choice, with an overwhelming majority of money in employer and sponsored retirement plans invested in mutual funds. Diversification, or the mixing of investments and assets within a portfolio to reduce risk, is one of the advantages of investing in mutual funds. Remember, when some go up, some may be down. A diversified portfolio has securities with different capitalizations and industries and bonds with varying maturities and issuers. Buying a mutual fund can achieve diversification cheaper and faster than buying individual securities. Easy access. Trading on the major stock exchanges, mutual funds can be bought and sold with relative ease, making them highly liquid investments. Also, when it comes to certain types of assets, like foreign equities or exotic commodities, mutual funds are often the most feasible way. In fact, sometimes the only way for individual investors to participate. Economies of scale. Mutual funds also provide economies of scale by foregoing numerous commission charges needed to create a diversified portfolio. Buying only one security at a time leads to large transaction fees. The smaller denominations of mutual funds allow investors to take advantage of dollar cost averaging. Because a mutual fund buys and sells large amounts of securities at a time, its transaction costs are lower than what an individual would pay for a securities transaction. So it's like they get a big discount because they buy a lot at once. A mutual fund can invest in certain assets or take larger positions than a smaller investor could. So they put all their money together in a bucket, and the bucket can buy a lot more at once. That makes sense. Professional management. A professional investment manager uses careful research and skillful trading. A mutual fund is a relatively inexpensive way for a small investor to get a full-time manager to make and monitor investments. And guys, if you have money to invest in this type, like ETF, or have an investment manager, even for a small amount of time, I would do it. Because just like I put money into Robinhood 2 years ago to watch it, I would want to watch what they do. I love to learn by watching other people. So I would definitely, in my portfolio, I will definitely have bonds and I'm going to have everything. Mutual funds, bonds, I want it all, guys. But eventually, we don't start with that. If you can start with that, it might be a good lesson for you. But if you cannot start with that, let's learn it on, what did I tell you? Paper money, guys. Paper money, it's beautiful. It's a beautiful thing. It's like being at school, but you're not at school. Free money. So, inexpensive way to get a full-time manager to make and monitor investments. Mutual funds require much lower investment minimums, so these funds provide a low-cost way for individual investors to experience and benefit from professional money management. So like I said, if you have a little bit of money to invest in one of these, it might be worth it to start it now because you're going to be investing. You pick a good one. We look it up, and you pick a good one with a good return, and then you watch it and you learn from it. If you can watch what a paid money manager does, it's probably something that you want to do in the market, right? He's paid. He knows what he's doing. He or she would be great to watch and learn from. So if you do that, let us know what you learn. So variety and freedom of choice. Investors have the freedom to research and select from managers with a variety of styles and management goals. A fund manager may focus on value investing, growth investing, developed markets, emerging markets, income or macroeconomic investing, among many other styles. This variety allows investors to gain exposure to not only stocks and bonds, but also commodities, foreign assets, and real estate through specialized mutual funds. Mutual funds provide opportunities for foreign and domestic investment that may not otherwise be directly accessible to ordinary investors. Transparency. Mutual funds are subject to industry regulation that ensures accountability and fairness to investors. The pros: liquidity, diversification, minimal investment requirements, professional management, and a variety of offerings. The cons: high fees, commissions, and other expenses, large cash presence in portfolios, no FDIC coverage, difficult in comparing funds, lack of transparency in holdings. So the cons of mutual fund investing: liquidity, diversification, and professional management all make mutual funds attractive options. However, mutual funds have drawbacks too. No guarantees. Like many other investments without a guarantee return, there's always the possibility that the value of your mutual fund will depreciate or go down. Equity mutual funds experience price fluctuations along with the stocks in the fund's portfolio. The Federal Deposit Insurance Corporation, or the FDIC, does not guarantee mutual fund investments. Cash drag. Mutual funds require a significant amount of their portfolios to be held in cash to satisfy share redemptions each day. To maintain liquidity and the capacity to accommodate withdrawals, funds typically have to keep a larger portion of their portfolio as cash than a typical investor might. Because cash earns no return, it's often returned as a cash drag. High costs. Mutual funds provide investors with professional management, but fees reduce the fund's overall payout, and they're assessed to mutual fund investors regardless of the performance of the fund. Since fees vary widely from fund to fund, failing to pay attention to these fees can have negative long-term consequences as actively managed funds incur transaction costs that accumulate over each year. Diversification and dilution. A play on words is an investment diversification, so it gets worsened and diluted. An investment or portfolio strategy that implies too much complexity could lead to worse results. Many mutual fund investors tend to overcomplicate matters. That is, they acquire too many funds that are highly related, and as a result, lose the benefits of diversification. Dilution is also the result of a successful fund growing too big. When new money pours into funds that have had strong track records, the manager often has trouble finding suitable investments for all the new capital to be put to good use. The Securities and Exchange Commission, the SEC, requires that funds have at least 80% of assets in particular type of investment applied in their names. How the remaining assets are invested is up to the fund manager. However, the different categories that qualify for the required 80% of the assets may be vague and wide-ranging. A fund can therefore manipulate prospective investors via its title. A fund that focuses narrowly on Congolese stocks, for example, could be sold with a far-ranging title, like International High-Tech Fund. End of the day trading only. A mutual fund allows you to request that your shares be converted into cash at any time. However, unlike stocks that trades throughout the day, many mutual fund redemptions take place only at the end of each trading day. Taxes. When a fund manager sells a security, a capital gains tax is triggered. Taxes can be mitigated by investing in tax-sensitive funds or by holding non-tax-sensitive mutual funds in a tax-deferred account, such as a 401 or an IRA. Evaluating funds. Researching and comparing funds can be difficult. Unlike stocks, mutual funds do not offer investors the opportunity to juxtapose the price to earnings, the PE ratio, sales growth, earnings per share, or other important data. A mutual fund's net asset value can offer some basis for comparison, but given the diversity of portfolios, comparing the proverbial apples to apples can be difficult, even among funds with similar names or stated objectives. Only income funds tracking the same markets tend to be genuinely comparable. Example of a mutual fund. One of the most notable mutual funds is Fidelity Investments. Magellan Fund, FMAGX is its ticker. Established in 1963, the fund had an investment objective of capital appreciation via an investment in common stocks. The fund's height of success was between 1977 and 1990, when Peter Lynch served as its portfolio manager. Under Lynch's tenure, Magellan's assets under management increased from 18 million to 14 billion. Fidelity's performance continued strong, and assets under management grew to nearly 110 billion in 2000. By 1997, the fund had become so large that Fidelity closed it to new investors and would not reopen it until 2008. As of March 22, Fidelity Magellan has nearly 28 billion in assets and has been managed by Sammy Simniger since February of 2019. The fund's performance has tracked or slightly surpassed that of the S&P 500. So are mutual funds a safe investment? All investments involve some degree of risk when purchasing securities such as stocks, bonds, or mutual funds. Unlike deposits at FDIC-insured banks and NCUA-insured credit unions, the money invested in securities typically is not federally insured. Mutual funds are considered liquid assets, and shares can be sold at any time. However, review the fund's policy regarding exchange fees or redemption fees. There may also be tax implications for capital gains earned with a mutual fund redemption. What is a target date mutual fund? When investing in a 401k or other retirement savings account, target date funds or life cycle funds are a popular option. Choosing a fund that is dated around retirement, like Fund X 2050, the fund promises to rebalance and shift the risk profile of its investments, commonly to a more common approach as the fund approaches the target date. So, you can take this quiz to see if you can retire comfortably, and you can look at all of their other articles at the bottom. That was mutual funds, guys. So lots to think about before we jump in to a mutual fund, right? Don't forget, we have terms of the financial terms dictionary. If you get confused during any of these, if you don't know what it means, high yield, you can see if they have high yield. They have no high yield. That's okay, though. They have some things. Oh, see complete list. Man, they got a big list, huh? There you go. High yield bond. It's there, guys. Everything's there. Alrighty. So, we know now the basics of mutual funds. We will learn more. We'll touch more on them, guys. Let's check out this news and then call it a day. What is new in the finance news? Walmart raises full year outlook at first quarter sales top expectations. I don't go to Walmart. That's not to say I wouldn't invest in Walmart stock, but I do not go to Walmart. Let me know in the comments if you go to Walmart. I can't bring myself to go there. I went there, people push around, they push you, they act wild at Walmart. I don't need all that at a grocery store. Let's see, what do we got? Anything interesting? Talk about the debt ceiling every single day till they settle that, right? How many Americans retire with $1 million? How many guys think? Saving $1 million for retirement is a great goal to have. How many people do it? In fact, only 10% of retirees have $1 million or more in savings. 10%, guys. 10% have $1 million or more, but 80% of the United States act like they're rich. Make that math work. So this is the most recent study. The average retirement savings from $500,000 and less than half a million, guys. I wonder, that's crazy. Man, 65 to 74-year-olds have a median of $164,000 in their retirement accounts, while those 75 and older have $83,000 saved for retirement. That's not looking good, huh? That's not looking good, guys. 10% of us have $1 million. And with healthcare, what will retirement cost this year? What a comfortable retirement will cost you in each state. This is helpful. So in Mississippi, let's find our state. Let's go way down here. Okay, well, where's our state? Montana. There we go. Okay, look. The cost of a comfortable retirement annually in the state of Washington is $74,301 buckarookies. Okay, and I pull out my little handy dandy calculator, guys. Everybody get yourself a calculator. Just a little handy dandy one. You could probably get one like this that works off the sun right from the dollar store. I don't suggest going to the dollar store. It's gross in there. Lots of plastics that'll get into your lungs. But if you only have $1, go get it at the dollar store. 74301. And then how many years do I want to be retired? Let's say I say 60 and I want to live 20 years. Well, if I want to live 20 years, Jeebus, I better not live 20 years, guys. I need $1.5 million to live 20 years at 60. And that is if the cost of comfortable retirement annually doesn't go up. What if while I'm 60, it goes up to $100,000 or $200,000, and then I'll need $200,000? This inflation is going to get us, guys. What if I need $200,000 a year times 20 years? That means I need $4 million to retire. I need $4 million in my bank to retire when only 10% have $1 million. Even the $1.4 million. How am I going to get $1.4 million? You guys, I think, let's see, 70 people. Oh my word, 74,301. We could save, guys, we could save $74,000 right now and only be able to live comfortably for 1 year after retirement. But old Greg Becker took $15 million from a failing bank. Like it was nothing, guys. He could have paid for 15 of our retirements. I don't like it, guys. I don't like it at all. It's not looking good for us. $75,000 a year for retirement. Where's the cheapest state? Where do we need to move to for retirement, guys? Let's see. I'll live in one of the most expensive states. We don't want to live in any Alaska. Alaska don't even have nothing up there. Why is it so expensive? Literally. There's nothing in Alaska. Let's go to the cheapest state to live. Where do we have to live in retirement? Everybody look and see. Everybody got to live in Mississippi for retirement. And then you still need $55,000 a year comfortably for retirement. So even if you save up $55,000, guys, and you put $55,000 in your retirement fund, you can only live 1 year comfortably in Mississippi. Yum. Yum, guys. Our future's looking really good, guys. And these rich people, they're really helping us out. They are really helping us out, guys. Can I save $1 million in 30 years? Sure you can. Sure you can. So if you're making $50,000, the amount of money you'll need to save is a significantly higher percentage of your income than if you're making $100,000. We know that, but most of us make $50,000, not $100,000. So eat away your income at expenses. Meal prep, guys. Consider moving somewhere like Mississippi. Downsize your phone, internet, and streaming plans. If you want to reach $1 million in 30 years, you should start saving now. A good rule of thumb is to save at least 10 to 15% of your income. Wow. Wow. What if your income's $1,000? And then you only save 10%, right? Then you only save $100 a month for use $1,200 a year times 30 years. You only save up $36,000, guys. If you only make, let's say you're extremely poor, you're on Social Security and you get $1,000, even if you save $100 a year for 30 years, $100 a month for 30 years, it's only $36,000, which means you can't even live 1 year in Mississippi comfortably. Wow. You see why you need exponential growth on the stock market, guys? You see why you need to learn the stock market? Because they haven't set up, for 99% of Americans, they haven't set up this for us. They've set it up for themselves, guys. Because if we all had this, the number wouldn't be 1 million. It would be like 5 million. Or those people's monies wouldn't be worth as much. You see what I'm saying? If we change how much money we all have, we change how much money is worth, guys. If you go around giving everybody more money or allowing them to save more money, the people that have money in the bank, it doesn't mean as much. That's why they keep us low, guys. If you're 30 and you want to retire in 30 years with $1 million in savings, we'll also say you start at $2,000 and estimate a 7% annual return over 30 years. To save $1 million in 30 years, you'll need to deposit around $850 a month. Whoa. And if you make $50K a year, that's roughly 20% of your pre-tax income. So if you make $50,000 a year and you're 30, you need to save 20% of your income. Wow, guys, that means, that's crazy. Times 0.20, $10,000 a year. That's crazy. Super crazy. And then that means $40,000 after taxes is all that you'll have to live off of. Woo! I'll give you some ideas on this article. You guys could check it out. But I think that we are going to call that a stream. We're about at an hour, and we have looked at all the disconcerting and disheartening news that we can look at today. So, comfortable retirement, guys. You need at least $55,000 a year to live comfortably in Mississippi. And that means you need like $1 million to live for 20 years. If you want to live more than 20 years, you need more than $1 million. Or you don't get to live more than 20 years. You just have to go into it knowing that, come 80, I got to die. Oh, no. Why is this on Yahoo Finance? Hope the man that they gave birth from is rich. biggest and probably broadest asset bubble. Here's how he's preparing for it. Insiders load up on these 2 dividend stocks. First Republic CEO on banks collapse. Everything changed overnight. Yeah, right. Yeah, right. This is a lie, guys. Don't you ever believe somebody telling you that a bank collapsed overnight. Don't believe it. Nothing collapses overnight, guys. Your relationship, your friendships, your job, a bank, a business, nothing. Nothing collapses overnight unless it's hit by an earthquake. And I promise you these banks were not hit by earthquakes. Or some other natural disaster they could end overnight. But nothing changed overnight. He's lying. This man, what's his name? Let's see what this First Republic CEO's name is. The former CEO of First Republic told House lawmakers Wednesday that his bank was contaminated by the widespread panic that followed the March 10th fall of Silicon Valley Bank. No one at his company could have anticipated. Everything changed overnight, said Michael Roffler. No, let's add Michael Roffler's name. Michael Roffler and Greg Beckett. Those are the 2 CEOs that should never, ever work in finance again. Ever. Why? Why would we let them work in money? If he says he ran a bank, guys, and didn't know overnight, he didn't know. He didn't see the fall of Silicon Valley and think that it might have an effect on his bank. Well, then he's not a very good CEO, is he? You guys, I don't even know anything about banking and I don't know anything about money, but I feel like any of us could have been better CEOs. We run our households on less money than these people run everything on, and they couldn't see a change. Get out of here. You make one little tiny change to a poor person's money and they know immediately. They know immediately they are not going to make rent. Nobody goes up on the first of the month and says, "Oh my, I don't have the rent money." Liar. You knew you weren't going to have the rent money the previous month when you paid the rent. You're lying. This guy right here is lying, and we keep letting these money people lie to us. You want to know why we let them lie to us? Because we don't understand, guys. As a group, as a society, we are not financially literate enough to understand that old Michael Roffler is a liar. Greg Becker, liar. They are liars and they're lying to us about money. But we are too, and I'm going to say it as a society, we are too stupid to know that they are lying to us. So stop letting them lie to us, guys. The only way is to get smart, to get educated. Look at him. He looks like a liar. That's a liar face right there he's making. You know, when you look up, that's a sign of lying, and they caught him right on the camera. When your eyes look towards the ceiling when you're talking, he's not looking straight forward. He's looking up because he's lying. I called it, guys. This guy right here, Michael Roffler, he's a liar and a schlub. Tell us everything changed overnight. Everybody knows when they can't pay their rent. You know how else? Like, let's say you do have rent money for next month. You have $800 to pay your $800 rent, but your car breaks down, so you have to pay that. You knew before your car broke down that you had no emergency fund. You knew that your car was running crappy. If you didn't, you should have known. You should have been taking your car in or listening better. You should have known. There's no reason that anything with money changes overnight, guys. Like I said, unless there is a natural disaster. So unless this bank got hit by a freaking volcano, Michael Roffler is a liar. And Michael Roffler will go and get another job somewhere else, guys. And he's going to do this exact same thing. How much did Michael Roffler make in 2023 already, guys? How much? How much did he make? I bet it doesn't say in here. It doesn't say. And why? Why did Yahoo Finance not say how much Rothler made in a year? Like, he sold $1 million of his stock in mid-January, just like old Greg did. That's kind of fishy, isn't it? Rothler and Greg Becker both sold millions of dollars of stock in January. He also sold $1 million in November. Exactly what Greg Becker did, guys. He also sold some of his stock in Silicon Valley Bank. He did insider trading, guys. He knew before we knew in January, and he sold all of his items. That's why they had a run on the bank, because people are not everybody is dumb, guys. Some people are learning. They're learning about the stock market and they're buying. So when they saw in November, because this is public knowledge, after somebody sells a big amount of stocks, you can see. So when he sold in November and January, people that bank there, they saw those sells and they said, oh, no, you're not making a run on my money. And they went and got $40 million out of the bank, or $40 billion out of his bank. And then $100 billion in the ensuing weeks. They dropped confidence because he sold. You want to know why he sold, guys? He sold out of both banks because he knew, 100% he knew that the banks were going to fail. 1,000% he knew that the banks were going to fail. That's why him and his buddy Greg Becker pulled out. Ridiculous, guys. Learn more about it, because the only way to stop these guys, old Roffler and Becker, is to be educated about it. If they keep stealing our money and we keep saying nothing, they will keep stealing money. If we step up, like old, who was it? Which senator? Probably, which senator was it, guys, that said, not today, called them on it. It doesn't matter, though. It doesn't matter who they have to talk to in Congress or Senate, because they're going to still keep doing what they're doing, because he's going to go get a job doing this exact same thing, right? I think I did a responsible rule throughout to fulfill my duties. CEO, I think you have to take responsibility for the ultimate outcome of your institution. Yeah. This is ridiculous. Ridiculous. So, he says unlikely to acquire other struggling banks. Old Greg Becker said he's truly sorry, guys. I wonder where he's going to go get his next job at so he can be sorry again, right? He's sorry, but he has his $15 million. He's sorry, but he got his bonus. That's crazy, guys. We're going to pay for that. Taxpayers, our money will pay for his mistake. Our money will pay for his mistake. You see these two dudes right here? Both of these dudes, we're going to pay for their mistake. And look what they look like. Liars. It's ridiculous, guys. But you know who people are mad at? I'm going to show you. Let me show you who people are mad at. I'm going to show you why it's stupid. You see these people right here? A little kid, a single mom with two children, a person in a wheelchair, elderly people. You see these people right here? Imagine they're real people. Imagine this is a lady. Maybe she's got a little bit of color to her skin and her children have color to their skin, and they are having a hard time because they just came to this country, guys, and they are immigrants and they use food stamps. These are who people are angry at. They get this mother and her two children that get maybe $500-$600 in food stamps a month. This is who people are mad at. This guy right here, who needs help with his medical because he cannot afford his medical bills. He is in a wheelchair. You guys, he cannot work. He can work, but he cannot do all the things that somebody not in a wheelchair can do, and we don't know what his medical problems are. But because he gets help from the state, people are mad at him. These old people who worked their whole lives and now they can't work anymore, people are mad at them. But you know who they're not mad at? These people all together will never get $1 million of free money in their life, ever. These people taking necessities from the government will never, ever, ever get $1 million. But these guys right here, this dude right here, old Greg Becker and old frickin' Roffler, these guys right here took millions already. I'm talking this guy got at least $15 million this year. This guy, he got at least $3 million or $2 million that I know of. He sold $1 million in November. He sold another $1 million in January. We don't know what his pay was and we don't know what his bonus is. I'm guessing if he made 15, he made 12. So these guys made over $10 million. That is enough for their retirement in one fell swoop, guys. And we're not mad at them. Congress is questioning them like it's nothing. But these people right here, the family that are immigrants, the man in a wheelchair, the old people, people that really need our assistance, our government help. We hate them. We sit around on Facebook talking about the welfare society. I want new pictures going up for the welfare society, guys. This, and this. You know how much this man, Jamie Dimon, is getting in welfare this year? Ask him how much he's getting in bank help this year, so he can buy other banks and get even bigger. Welfare, guys, right here. Here's your welfare addicts. These guys. They're getting the most welfare from our country right now. The banks. These are the people that you should be talking bad about, not these people right here. So, that's what we say, look at this right here, old Clinton, an end of welfare as we know it. When was this? Clinton. This was back in 1996 when he signed that welfare reform. He signed welfare reform in 1996, but here we are in 2023, and these guys have no welfare reform. We let 2007 and 2008 bank collapse happen, and still no reform for these guys. Why? Why are we so angry at people that have gotten welfare when we're not angry at the people that get the most welfare? Leave you guys with something to think about. For tomorrow, I will see you guys same time, same place. Be there or be square. We'll have a new lesson and new things to talk about and a new day to learn money. So I will see you guys tomorrow. I hope you have a wonderful day. And if you can't make it tomorrow, like I said, watch the VODs, guys. Watch the videos. I record them, and they go into a folder called Stock Market Learning. And that's it. Have a great day, neighbors. Bye.